Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for September 1st, 2021. So today we're going to look at a growth stock called Chewy. And so remember, we always like to balance those growth names with some more kind of stable dividend names. We think that's the best kind of recipe for success because you don't want to ignore either kind of segment. There's certainly value to having both in your portfolio. Especially as you're managing the triple income wheel and writing cash secured puts, the different volatility profiles, I think, make a nice mix in your portfolio. So today we're going to talk about a company called Chewy. They actually report earnings today after the bell, and so this is one you're going to want to jump on and can kind of really look into as the day goes on today. So. We're going to look at kind of stuff to, metrics that you should focus on in the earnings call. And then we're going to look at, the chart, different support and resistance levels. We're going to look at valuation. So you can really kind of pinpoint where, this company is kind of going from a stock perspective and kind of justifying the valuation. And then also where the stock could possibly pull back to where you could add shares kind of through cash secured puts. Et cetera. This is a stock that I've done cash secured puts on probably 6-7 months in a row, and so this has been a really good stock for the triple income wheel. It's volatile, but there's certain levels you can kind of pinpoint that I think are kind of higher probability of success, if you will. And so those are some of the levels we're going to look at today. And then if you do own the stock, I think it's a hold today. I wouldn't necessarily sell it because I like the long-term trajectory of the business. We're going to look at, how this company can kind of grow into its valuation, if you will. And so I think covered calls, especially going into earnings where you can get, nice juicy premiums, I think make a lot of sense as well. So we're going to look at all that today, in this analysis. So let me first start by looking at some of the metrics that we need to focus on. So this was from last quarter, and you can kind of just see some of these growth rates. But these are all the key metrics that we're going to be looking for, during the earnings call today, because these are the metrics that really drive the business. And what I love about this business, right? And if you're not familiar with it, they're basically the Amazon of pet products, right? So they came on the scene a few years ago where they were kind of a loss leader and they kind of knew this, that, they carved out this niche of delivering heavy bags of dog food, right? This is something that no one wanted to do. And even Amazon, still doesn't really do it, in the scale that Chewy does, but it's expensive to ship, big dog food, but it's also a pain to go to the store and get it. And so now they're kind of a full suite of food, treats, accessories. They've gotten into pet healthcare. So if you own a pet, you have to do these monthly, heartworm and various kinds of medicines that are over the counter. They make it very easy to get all this stuff delivered right to your door. I know for me, owning a couple dogs, it's been great. Not having to go to the store and get heavy bags of dog food. So, it's a company that's certainly adding value, and they've figured out a way to become profitable. So they've been profitable the last 2 quarters. So I really like the trajectory they're on, and I really just think they're just kind of scratching the surface as far as customers. And, again, just the value proposition that they bring to the table with this. Because if I never have to set another foot in a pet store, I probably won't, right? And so this is a company I'm a customer of, and I like. It's just valuation is high, so you kind of got to justify, why you should get into a business like this. So they've got about 2.14 billion of sales. So just year over year, as of last quarter, that was growing 32%. So they're growing at a very nice clip. I think what's key to their metrics is really this active customer growth. So their active customers also grew about 32%, quarter over quarter or year over year, to about 20 million. And so active customers are obviously ones that have purchased within the last 12 months. And so that's kind of the key, metric driving this, right? As long as they continue to grow their customer base, that's something that I think we all want to see going forward, and they've been doing it at a very nice clip. And I think as more and more people realize the value proposition of what they do and they expand their products, they're certainly going to continue to grow that, as well as net sales per active customer. Okay, so this is a key metric too. So of all these customers, how much are you generating per customer, right? And so this metric was up about 9% year over year. Again, this one doesn't grow as fast necessarily as the actual customer base, but if they can keep this growing, it's a pretty kind of impressive proposition they have. And so this is all customers here, and so what they've realized over time as they've analyzed the kind of cohorts of customers coming in, and this is what I really like about it. The longer a customer stays with them, the more they spend, right? So this is average for all customers, but a customer that's, say, in year 2 may spend $400, but what they found in year 4 and 5, that same customer is now spending $700, $800, $900, right? And so as the customer becomes more ingrained with what the business done, they order more and more and more every year. So I think that's kind of an impressive kind of growth trajectory too. They continue to grow gross margins, which is important. So they're keeping their costs, kind of at bay as they scale. They've got a positive net margin, which means their earnings positive. So they're earning a positive net income. So that's a very positive thing, with a business like this, where they started off again knowing that they kind of had to withstand some losses to kind of get market share and scale, and they've done that, and now they're scaling up profitably, which is key. So they got positive net income, again growing at a very healthy clip. They're positive cash flow, which is also key. So you're positive on the earnings front, you're positive on the cash flow front now, which I think is a great time to kind of get into the business. Certainly if you're not currently in the business. So these are all the metrics we're going to look for. They're going to report numbers on all these, and so we're hoping to see continued growth in all these metrics, and these are really the key ones to look for. So now let's jump over to the stock profile, and I'll just jump into the let's jump into the chart first, just so I can kind of show you. So again, this company's only been public for a little over a year. I mean, you can kind of see the volatility, right? I mean, this is typical of a company like this. And again, they just became profitable over the last couple quarters, and so you kind of see how they had this huge kind of run up. Clearly this was a company that benefited significantly from the pandemic, right? We were staying at home, so everyone was starting to order things online. But I think what it did is it just accelerated the value proposition that it provides, right? And why post-pandemic, if you saw the convenience of ordering this stuff online and not having to go to a pet store, why would you want to go to a pet store now, right? I mean, it's one of those things where I think it just accelerated some of that growth. But I think these customers are going to be around for a long time, and it really just helped the company scale. So I think this was certainly one of those companies where the pandemic was a positive in kind of pushing and moving the business model forward. And so you can kind of see it was hovering around kind of $25, roughly $25-$30, but before the pandemic, ran all the way up to about 120. So from the IPO price to its peak, it was up about 240%. Not crazy. I mean, we've seen some bigger moves from some other kind of smaller high growth businesses. And then this one was not immune from the tech scare. So when interest rates started to rise, right, all these growth companies, because it really wasn't a tech scare, it was more of a growth stock scare as interest rates are rising, sold off about 45%. But you can kind of see, I mean, we're kind of establishing a new range, if you will, with the stock, and this is where I kind of expect the stock to kind of continue in kind of a range like this. So we hit from this low here of around kind of $65, $66. After that sell-off, we were, stock was up about 46%, and then it's kind of just bouncing around here. And so there's a couple levels that I would look at just kind of as support. And by the way, this is the consensus target right now, right around 101. So the analysts are still pretty positive on the stock. But again, we're going to look at valuation in a second. I think you're kind of capped on where this stock could possibly go just short term, just because of the valuation. And so again, my expectations are that we're going to kind of hover around in this range for a while, which makes it a really, really good triple income stock. So selling covered calls and buying cash secured put or selling cash secured puts really is the way to go. So I think on the low end, obviously this 66 level could be in play, and then I would even say the high end. I could definitely see it hitting 100, but I don't know that we're going to hit new highs at 120 anytime soon. So I would say this is a kind of a safe potential range for the stock just over the short term until we get a couple more quarters under our belt of this growth that you eventually would break out through this level. But I think you've really got to show some good earnings growth to kind of again justify breaking out again from that high level peak that they saw around 120. So I would say this is kind of a safe range for the stock. Again, it's a pretty big range, right? It's a $30 plus range on a $100 stock. So you've got kind of some room to move there. But because the stock's been volatile, you're getting nice premiums and nice margins of safety with these options, and which is why again I love selling puts on some of these higher growth names, especially if we can pinpoint good safe areas to do so. And so you see I have this green line in here as well. So this was kind of this area where it was consolidating before, and again sometimes these dips overshoot a little bit. And again, this was during this time when interest rates were spiking. So, that this isn't necessarily a reasonable level either. Because I think interest rates will probably remain stable, for the next, at least, 12 months. So, I don't know that this level will be hit. It's something to consider on the low end, but I would say the shorter term range is right around the $76 level. You can kind of see it hit multiple times, throughout this time frame. It hit there, again, kind of twice just on this kind of upward trajectory it's on right now, from that low. And so I would say that kind of $75, $76 level is probably pretty good, especially going into earnings. So you've got your, 50-day and 200-day kind of conversion right here. Again, they've kind of had a little bit of a roller coaster ride on that 50-day, that shorter term moving average. But I'd love to see that jump back above that 200-day. So if we can keep some stability kind of up in this area, we're going to see that, which will just kind of put that long term uptrend in place, which is what you want to see. So that level's right around 86. So only a couple dollars kind of below where it's at right now. And so that's kind of a key level. So we'll kind of see into earnings. Unfortunately, I do expect some decent move one way or another with earnings. And so, again, I could see this thing potentially popping up to $100 a share on the upside. And then again, I think the downside is probably in this, 75 to 76 range. So that's the range I would say that we're going to consider on earnings, right? This range right here. So kind of just call it 75 to 100. And the stock's currently trading right around $88 a share. So kind of keep that in mind as we're looking at both calls and puts, just kind of in the short term. So that's kind of what I'm thinking on the chart. But you can definitely pinpoint some areas here that I think make some sense. So let's look at the profile quickly. Again, this is it's a growth stock, so you can't really pay attention to some of these metrics per se. It's just, again, it's growing so fast. You kind of got to focus on the different metrics, right? You gotta focus on some of those, customer growth, the continued growth and profitability, top line sales, and certainly the amount of customer spend that they're seeing right now as well. So, our strike zone. This is a stock where we're requiring a decent, minimum margin of safety of about 13-14%. Our strike zone 68 to 77. So again, kind of right in that, lower part of the range that we just talked about. And as you'll see in a second, we can actually find, good cash secured puts in that level. So that makes me feel, pretty comfortable. Again, it's a higher volatility stock. We're right around, 55-60% on the implied volatility, which matches, pretty closely with what it's done historically as well. Again, it's only been around, a little over a year. So take that with a grain of salt, because I think this volatility will come down over time. And we're about 26% below the peak. So we got a positive pullback indicator here, right? The stock's already pulled back quite a bit. So if we can get even in a additional kind of margin of safety here, I think it makes a lot of sense. And again, the company reports earnings, after the bell today. So, if you're interested in this particular trade, it's one you want to kind of jump on today. So let's look at valuation quickly. There's not much to say. I mean, it's overvalued by any kind of metric you kind of look at. Well, and I shouldn't say that. I would just say, on an earnings basis, it looks crazy, right? It's at right around 200 times earnings, but they are profitable, right? Some of these stocks that are not profitable are trading at ridiculous kind of multiples of sales. And I would say, for a company growing at the rate it's growing, I mean, 3.4 times sales isn't crazy. Because this is a retailer, but it is obviously online focused, so it's definitely got a pretty big kind of tech component to their whole business model, kind of very similar to Amazon, right? So on a forward basis, the sales don't look awful. Again, it is cash flow positive as well. So the fact that we're even seeing forward multiples here and they're not all NA shows that again, the company is profitable and it does generate some positive free cash flow as well. So these metrics will come down over time, and it's really trying to just kind of grow into those metrics. So I would say, again, they just kind of became profitable in, And so their fiscal year actually ends in January, and so 2022 will actually be January of 2022. That's when their actual 2022 fiscal year will end. So they're expecting, again, they've been profitable the last 2 quarters. They generated 5 cents in Q4 and then 9 cents just last quarter. And so they're expecting 14 cents for fiscal year end 2022. And then they're expecting, so out in 2023 and 2024 is really what you kind of want to look at. And the trajectory here is pretty significant. So in 2023, they're expected to be at 40 cents, way up here, if we were looking at this chart. And then by 2024, they're at like 80 cents, right? So this trajectory of earnings is really going to kind of pick up in 2023 and 2024. And so, this is roughly like a 200% increase between 22 and 23. And then we got almost another 100% increase there. So earnings are going to be growing very fast. So, kind of based on 24 numbers, if you're really kind of looking out a little bit further, this PE will probably be down in the 100 range, right? And so as they continue to grow over the next 3 to 5 years, that's when you really kind of grow into this valuation, especially if they're growing at the pace that they're growing at right now. So, again, this is earnings growth that you won't see from a more stable business, and so you kind of got to take that all into account as you're looking at some of these valuation metrics as it makes sense. But I think the more important thing is really just looking at some of those support and resistance levels, and as long as the company stays on this trajectory, I see it at least staying in those ranges that we kind of talked about. So let's take a look at some cash secured puts. Again, we're looking at October now. So October 15th is is the October monthlies that we're looking at. And again, it's got earnings risk, but there's plenty of opportunities that we see in the strike zone, right? Highlighted by this green box. And so, obviously we're looking for kind of a 1% kind of average monthly yield. So, you can look either at this, you got a couple choices here, right? You could go at the 70 or 75. And so I would say, given that these deltas, if we go up to the 75 and we just looked at the chart, right? I think this stock could certainly get some support around 75. So I kind of like that level. So again, we're 45 days, so we're about a month and a half out. So with this one here, again, it's really going to depend on, earnings. I mean, this is really an earnings play, but then you've got, another 45 days to let the stock kind of consolidate and stuff like that. So, this one is in the strike zone. So I would say, this would probably be a good base strategy. If you want to be a little bit more on the conservative side from the base strategy, if you're just not fully comfortable, with this, the 70 again gives you an even bigger margin of safety. You got a delta way down at 11, and so if you can get 1% average monthly yield with an 11 delta, that's pretty impressive as well. So I would say either one of those for the base. If you're a little bit more on the conservative side, you can do the 70. For the actual conservative portfolio, again, this is, we're targeting about a 0.5% per month, but you can see the metrics here, a delta at 6, very big margin of safety, and down at the 65 level. And then on the aggressive side, you can go up to this 80 level. That gives you a 2.6% average monthly yield. Still a delta under 30, and then almost a 10% margin of safety going into earnings there. So a little bit outside the strike zone, but not too far out. But those would be our plays for a cash secured put. And again, I've continued to sell cash secured puts on this company for pretty much all year, and have had success pretty much every month. So I like the risk reward of this company with the triple income wheel for sure. Now, if you do own stock, let's take a quick look at the covered calls, because again, I think the price should probably be capped here. The valuation is very high, and even the next few quarters, they're not really projected to grow like crazy. It's going to take a few years for this company to kind of grow into it. So I definitely see kind of a range bound type situation, and not, a stock that's just going to kind of start going through the moon here. So if you own it, again, I wouldn't sell it. I'd definitely hold it, because I like the long-term trajectory of it. But I would definitely look at some covered calls potentially, because they're pretty juicy, especially going into earnings. And so if you look at, again, the 10-15s, and I would go above $100. So I'd maybe focus on, this 100 to 110, which gives you quite a bit of upside. So remember, in cash or in covered calls, we're still looking at the average monthly yield, but we're looking at the upside profit as well. So the upside profit is the total profit you'll make off of the premium yield, as well as the increase in stock price from the current level. And so the 100 would give you almost a 2% average monthly yield, with a 16% upside profit. So essentially, if in 45 days, a month and a half, if this stock went up through 100 and you had to sell it at 100, right? Because with covered calls, you're obligated to sell the stock at the strike price. You could make 16% in 45 days, a month and a half. If you went up to the 105, you get a 1.3% monthly yield and a 21% upside profit. So that one I like. Again, that one puts you, squarely above the 100 level, and I think the 100 might actually act as some resistance here in the short term. So I think either of those would probably be fine, and I don't think you're going to lose your stock. But I would maybe focus on this 105, because it gives you a little bit of cushion above 100. The consensus target again is right around 101 for the next 12 months. So, this is one I really like. Again, you can generate, another % plus per month on your stock, right? Essentially, you're creating your own dividend, right? You're creating a dividend of 12% plus per year on a stock that you're just you want to own because you like the long-term prospects of it. So this is very attractive, I think. And if you want to be more conservative, again, you didn't want to lose your stock necessarily, and just want to generate a little bit of extra income there, you could go up to the 110. Again, that gives you a 26% upside profit potential, and right around 0.8% per month. So those are the ones I would consider. But I think this stock just makes a ton of sense from a covered call standpoint, and I think a ton of sense from the cash good put standpoint. So it's, again, company I love. Reports earnings today, September 1st, after the bell. So if you're interested in it, I'd certainly look at it sooner than later. Take care.